Our other sponsors include the British Chamber of Commerce, the Australian Chamber of Commerce, the South African Thai Chamber of Commerce, the Thai Canadian Chamber of Commerce, and the Money Channel. So thank you very much for your sponsorship. Okay, I won't talk about too much about what IDEAEconomics is, because I believe Paul Gambles has got a little bit to say about that in his presentation. But just a little brief. IDEA is a non-profit organisation dedicated to the reform of economics. Economics failed to predict the biggest economic event in generations, it failed to repair the damage, and it fails to provide relief to real businesses and real people in the aftermath. IDEA's goal is to educate policymakers, the public, and economists in what it calls the three basics, which I think Paul will probably talk about in a little while. So just to introduce our two speakers for the evening, Paul Gambles, if some of you don't already know him. Paul is the co-founder and managing partner of the MBMG Group. The MBMG Group was established in 1996 as a diversified professional services practice, and today employs almost 100 specialists in financial planning, investment advisory, corporate finance, accounting, audit, law and tax planning for personal, corporate and institutional clients in Thailand. Paul is licensed by the Thai Securities and Exchange Commission as a securities fundamental investment analyst, and is well known as an expert economic commentator, appearing most days on the Money Channel's 10 o'clock news, as well as monthly appearances as a guest host on CNBC's Squawk Box and Squawk Box Europe. I believe Paul's going to go first tonight. We will have a brief intermission while we change laptops over our next guest speaker, so bear with us while we do that. To introduce Steve Keen. Steve Keen is Chief Economist at the IDEA and is Head of the School of Economics, History and Politics in Kingston University in London. At Kingston, his mandate is to form the first economics department in Europe which truly goes against orthodox teaching. Should be interesting. Steve was cited as the economist who best predicted the Great Financial Crisis and the Great Recession which follows. He also authored the book Debunking Economics, which has recently been published in both French and Spanish. As the title suggests, it explains economic history, theory and practice without the need for an economics PhD before you pick it up. Probably help me a little bit. Steve also writes on the influential Debt Watch website, as well as dozens of academic papers. He's received an award for the economist who most accurately predicted the 2007 financial crash, and the ensuing GFC which followed. So as I say, we'll have a presentation first of all from Paul for about 20-25 minutes, the same from Steve Keen, after which we'll have a question and answer session. I believe we'll get Heidi with a microphone going around, so there's no need to go to the back to answer questions, just put your hand up. So without further ado, I'll hand over to Paul Gambles. Thank you.
Thanks, Todd. Thank you, everybody, for coming. I'm actually going to do something unusual, in fact, probably unprecedented for me tonight. I actually, if technology works right, I plan to be silent for the first 5 minutes or so of my presentation, because I'm going to show everybody a video here. It's by an animator called Omid Malakon. He's not actually an economist. So we're here to talk about economics, and I'm going to show a cartoon by somebody who's not an economist. He works in real estate, and he produces short animated films to try and illuminate some of the economic issues. Because, as Todd pointed out, I am actually an analyst registered with the SEC, although a lot of people think that when they talk about me, it's only the first 4 letters of analyst that apply. Think about that. I have to point out, this isn't actually investment advice. In fact, it's not actually real. It's a cartoon. But sometimes it's hard to tell what is satire and what is real.
Use the mouse pad.
Oh, it might be easier. Isn't technology great?
Just get it running and then click. It should be okay. Okay.
Here we go. Okay.
Where's the sound?
We don't have any
It's
sound.
a volume.
Effect.
What do you mean?
Taxes are something you pay only after you have income. So where do rich people get their income?
Many wealthy people make their income off of their investments.
Hasn't the wealth disparity grown substantially during the recession?
Yes.
How could the investments of wealthy people be doing so well in a recession caused by a financial crisis?
Excellent question. The rich made a lot of money on their investments when the going was good, but didn't lose that much when things went bad.
So the rich get richer on the way up, but they don't get poorer on the way down.
Yes. And here is the poster boy of that disease.
That's Warren Buffett, the second richest man in America.
But also its biggest welfare recipient.
How?
Going into 2008, Buffett was one of the biggest investors in financial companies. He made lots of money off the financial boom.
Did he still have those investments when the boom turned into a bust?
Yes, and Buffett was about to lose a fortune.
So what did he do?
He made an even bigger bet on banks that were about to go under, then went on television.
If I didn't think the government was going to act, I would not be doing anything this week. I might be trying to undo things this week. I am to some extent betting on the fact that the government will do the rational thing and act promptly. It would be a mistake to be buying anything now if the government were going to walk away from the Paulson proposal.
So he said he expected a bailout, and if he didn't get one, he might be selling his bank stocks?
Yes,
But he is the world's most respected investor,
he is.
and many copycat his investment decisions.
They do.
If he started selling, it would have been a disaster.
Yes,
So he basically blackmailed the government into bailing him out.
exactly. And they did. Some of the bailouts were targeted specifically for banks that Buffett had big bets on, and the government made sure Buffett got a better deal than taxpayers.
Then what happened?
Bank stocks rebounded, and Buffett made a fortune off the bailouts.
What did taxpayers make?
Bupkis.
And millions of people still lost their house.
Yes,
And millions more lost their job.
that's how the wealth disparity increases after a financial crisis.
Where is he going?
To write an editorial on how his income taxes should be higher.
How much more would he be paying if his taxes were higher?
A few million more each year.
But how much did he profit from the bailouts?
Billions.
No wonder he'd rather talk about tax rates.
It's a good distraction from the money he made off the bailouts. But he's not the only one. Bank executives and shareholders profited too, as did other wealthy people.
That would explain why the poor are suffering more than the rich. But at least the bailouts are over.
No, they are now bigger than ever, thanks to this guy.
That's the Bernanke.
Also the anti-Robin Hood.
Why?
He takes from the poor to give to the rich,
How?
with ever more quantitative easing.
Dude, why are you still doing the same failed policies?
We think that these policies can bring interest rates down, not just Treasury rates, but a whole range of rates, including mortgage rates and rates for corporate bonds.
But if you are poor, unemployed, or already lost your house, lower mortgage rates are useless.
Only the wealthy can easily take advantage of low rates.
And who benefits from lower corporate bond rates?
Big companies. Small businesses have a hard time getting a loan.
If low rates can't help those suffering the most, why do you keep printing money?
It also affects stock prices.
This guy seems obsessed with making the stock market go up.
He is.
But who owns stocks in America?
The richest 1% owns a third of all stocks. The richest 10% owns 2/3.
So what the Bernanke is really doing is helping out people like Warren Buffett.
Yes, but don't expect Buffett to write an editorial on that subject either.
What's the Bernanke's justification for making stocks go up?
He thinks higher stocks create jobs.
That makes no sense. Companies don't hire people because their stock has gone up. Dude, how are higher stocks supposed to create jobs?
If people feel that their financial situation is better because their 401k looks better, if house is worth more, they're more willing to go out and spend.
But spending more because your stocks are doing better was proven disastrous by the internet stock market bubble.
Yes,
And spending more because your house is worth more was proven disastrous by the housing bubble.
of course.
You'd have to be an idiot to repeat those mistakes.
An idiot. Or an economist.
What's all this money printing doing to commodity prices?
Gas prices are the highest they have ever been for this time of year, despite weak demand.
Dude, what about this spike in gas prices?
The committee expects that effect to be only temporary.
That's what he said in the spring.
It's also what he said last year.
How could something be temporary if it keeps happening? Seriously, you can't just keep saying these problems are temporary.
The committee expects that effect to be only temporary.
What the hell?
Temporary.
temporary, 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 temporary.
He's freaking out.
He thinks if he keeps repeating the same wrong, it will eventually be right.
That explains his policy decisions.
Meanwhile, the poor that live paycheck to paycheck are disproportionately hurt by high gas and food prices.
And the rich that own all the stocks and get all the loans are getting richer for doing nothing.
That's how the Federal Reserve increases the gap between the rich and the poor.
Temporary, 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 temporary.
Thanks for watching, everyone. For a better understanding of how the Fed drives gas prices, check out this cartoon. You can learn more about inflation in this cartoon and quantitative easing in this other one. Check out this website for more. Bye-bye.
Okay, so probably professional suicide there. I work in the wealth management business, and we've just insulted Warren Buffett. I'm by many standards, are supposed to be classed as wealthy, as are all my clients, and we've talked about why we have to have a look at wealth disparity, and then to cap it all, I'm an economist, and what was the quote there? Economists are idiots, was it? So, okay, let's see if we can recover from that. Omid obviously uses humour to try and amplify a whole bunch of points. I'm not nearly as entertaining or amusing as him, so I'm actually going to use statistics instead. What we have here is a chart that shows three things. It shows a normal distribution bell curve, which is if we had a society where rich and poor were basically split down the middle, it was a mirror image, then that's what it would look like. If in reality, it actually looks like the bell chart on the left-hand side, where in America today, most of the wealth is actually owned by a very small number of people. Now, as I said, I'm a big believer in wealth. I'm a big believer in people being able to make themselves wealthy. But if we get to points that become too extreme, then there's a real danger that the system can actually just completely eat itself. And an example, I suppose, that struck me was anybody who's watched the news recently knows what's been going on in places like Ferguson in the US. And obviously there are a lot of proximate causes as to why that happened, but there's also a lot of underlying causes too. And the middle chart there, I'm not sure how well you can read that, but it shows the average wealth of blacks in America, Hispanics in America, and white people in America. And you probably don't actually need to be able to read the labels to guess which one applies to which. The recession has had a huge impact on again, I'm going to focus on America just because obviously it's still the world's richest country, and it's a great source of data. So since the recession, what we have seen is that the disparities have got even greater. The top 5%, obviously the top light blue line there, if we compare that to the bottom 25%, it shows the extent to which wealth in America has really got badly stratified. And it's kind of very obvious why. The chart here shows average incomes. It shows the number of men, women, number of women working, and it shows average incomes. Average incomes in America have not increased since 2005. Which is one reason why in the States, despite the fact that the US stock market is booming, the median wealth per American adult hasn't really improved in global terms over the last 3 years. We've seen a almost record stock market boom, and yet American median wealth has fallen from a ranking of 24th in the world to 25th in the world. And we can see where the top 5 wealthiest countries are: Australia, Belgium, Iceland, Luxembourg, and Italy. Again, these charts all make the same point. They show what's happened to average household wealth in the States. We can see that on average, most people are getting poorer. There is one one significant exception to this. I'm not sure how well you can read that chart there, but the average wealth in the US is about $120,000. But if you made the right career choice, that doesn't apply, because the average wealth in Congress is about $912,000. So maybe a lot of it is about making the right career choice. There's a graphic that we particularly liked that showed what would happen if we showed American wealth as a map of America. So this is the part that the top 1% would now own. The top 10% basically own everything above this line. 40% of America is represented by this tiny little dot here, which for anybody who knows their American geography, coincidentally just happens to correspond to San Antonio. But I don't think we're making any negative comments about San Antonio or Texas. We'll leave that for everybody else to do. What the chart here shows is the relationship between mean and median wealth going back over time. So mean wealth and median wealth in a society that distributes its wealth fairly would be fairly close together, and we can see what's happened. The gap between mean and median wealth has just absolutely skyrocketed. So it suggests that there's a problem with the way that wealth is actually distributed in America. And just in case anybody's starting to think that I'm picking on Americans, that's only partly true. I'm now going to pick on Brits too. We have a lot of the same problems. If you look at this heat map of wealth in the UK, you can see that wealth in the UK is very geographically concentrated. And again, if you look at the change in wealth in the UK, people who live in London have been getting an awful lot wealthier, while most of the country has been getting rather poorer from 2008 to 2010. So the comment in the video about wealth being subsidized by the majority or by the poor seems to be absolutely spot on. And just in case anybody's feeling left out, if we've got any Europeans here tonight, then going to have a pop at Europe too. In Eurozone, we've got exactly the same situation as in the States, median and mean wealth getting further and further apart. So what this means is essentially that the amount of wealth within the country is just being concentrated in an ever-decreasing, ever smaller number of people. And that's a problem. It's a problem in a lot of ways. It creates issues like social immobility. It becomes very, very difficult for people to break out of their socioeconomic brackets. But it also ultimately ends up creating, massive socioeconomic problems. It turns societies against each other. It becomes, even on a fundamental economic efficiency level, it becomes a problem. If you take this to its ultimate extreme, if all the wealth were concentrated in the hands of one person or one man, then he'd own all the businesses, but there wouldn't be any clients, there wouldn't be any consumers, there wouldn't be any users for that business, because no one else would have any wealth to pay for it. And while that might sound extreme, we're probably not a million miles away from that. The last time that we had wealth and income disparity levels as fragmented, as severe as they are today, was back in the late 1920s. And I think we all know what happened during the 1930s. As Steve is fond of saying, a man with a very small moustache and a very large ego ended up causing an awful lot of trouble in Europe. But there were actually social and geopolitical problems all over the world at that time, and a lot of them can really trace the root cause back to the levels of income disparity that we had. So that's, for us, that is simply one symptom of the problems with the way the world economy is run today. It's not the only one, but it's a very glaring one. It's a very easy one to observe. My day job, obviously, is as a financial analyst with MBMG, but in my spare time, which I don't get nearly as much as I'd like to, I actually support this organization called IDEAEconomics, which we're launching in Asia here tonight. IDEA is a group of eminent economists who are basically dedicated to the idea of educating the world about the fact that we all think economics is broken. And by that, what we mean is there are three real fundamental, basic issues that dominate the economic landscape that all too often seem to get ignored. The first one is that debt actually matters. That might seem obvious to everybody sitting in this room, but if it does, it probably means you're not an economist. A classical economist would tell you that debt is actually just a medium of exchange. It doesn't make any difference to anything and has no relevance to any economic models. I think we find that a little bit hard to swallow. The second one is we actually think that money matters. Again, it may seem fairly obvious, but to a neoclassical economist, it's just a form of exchange. Probably part of their confusion is caused by the fact that in the economic system that's widely taught today, it's actually believed that money goes around creating loans, deposits go around creating loans. I suppose it's understandable why people think that, because if you look at the statistics, there is a correlation. Unfortunately, it's the causality is the wrong way round. If you think about it logically, whenever a bank issues a loan, that's what goes and creates a deposit, because that then has to go somewhere. So there is a relationship between the two, but the classic way economics is taught has got that the wrong way round. That may seem like we're arguing about a technical detail, but the whole theory of policies like quantitative easing are based on the fact that the people who devise those policies have actually misunderstood this, and they've actually put the cart in front of the horse in their diagram. The third principle that we have at IDEA is that the economy is dynamic, i.e. it changes, it moves, it progresses. There's a lot of moving parts. They all interact with each other. Again, neoclassical economic models would tend towards a much more static view, or even an equilibrium view of the economy. If you look at the model that people like Ben Bernanke use when they try to model what goes on in the economy, one of the things that makes us a little bit suspicious about it is that if you run their model for 100 years, 1,000 years, 100,000 years, infinity, it never actually generates a single recession. And when it's pointed out to them that maybe that makes it unrealistic, they try to reverse argue that no, their model's right, recessions are the things that are unrealistic. And I have a slight problem getting my head around that, I suppose. So who is IDEA? IDEA is a non-partisan, non-profit organization essentially designed to go and spread the message as to how economics really works. There aren't really any great secrets here. There are a lot of people who've written very accurate economic treatises, economic models over the years. Unfortunately, for whatever reason, their work rarely gets taught in most universities. We're lucky that we've got a university professor here tonight who actually heads up one of the very few schools of economics that tries to teach real-world economics and not the Ben Bernanke model. So if you look at the economists that we're fortunate enough to have on our panel at IDEA, Steve Keen, who's obviously here. There's a lady called Anne Pettifor, who's written some astonishingly insightful work about debt. Dirk Bessemer from the Netherlands, James Galbraith, Michael Hudson. What these people all had in common is that they were amongst, I think, the 13 economists in the world who were cited as having predicted the 2008 global financial crisis. I'll just repeat that, 13. There are 36,000 registered economists, or over 36,000 registered economists, so that means 35,900 and something actually didn't expect the global financial crisis in 2007, 2008. And they're the ones whose models are primarily in use at the moment. I won't say much more because I think most people actually want to hear from Steve. What I will say is it's not just economics where there's a history of misunderstandings, misconceptions. You know, I've developed this phrase lately where keep saying that if Dan Brown, the man who wrote the Da Vinci Code, if he were an economist, I think he'd call the economic systems that are in use the dark con of man, because people are basically being given a system that's untrue, half true, largely based on propaganda or falsehood, and to that extent, I've cast Stephen here in the role of a 21st century Rachel Carson. I don't know if anybody knows who Rachel Carson was. She was an American grandmother who authored a book in the early 1960s called The Silent Spring, and she was motivated to go and write that book because she noticed that there were less and less birds every springtime, and she wondered whether there was some connection between this and a phase, I suppose you'd call it, that American public health authorities and other public health authorities around the world were indulging in, and largely sponsored by interests of chemical companies at the time. There was an idea that the most beneficial substance known to man was a thing called DDT, and it was sold for use at home. That's actually a real advertisement at the time. A top model was actually paid to stand in a spray of DDT because everybody thought that it was so good for you. And you can see here, DDT is good for me. People were splashing it behind their ears almost like cologne, because the belief was that insecticide was going to make us all cleaner, better, and healthier. And largely thanks to people like Rachel Carson pointing out that if it was killing all the birds, it probably wasn't doing us too many favors either. Then a little bit more serious research was done into it. And luckily in America, for the last 40 years, DDT has been banned as a substance in public places. So I suppose what I'm hoping and expecting that Steve is going to do is that by the year 2060, our kids and our grandkids are going to look back and shake their heads in disbelief that our generation actually believed that economic policies like QE were good for you. So that's my part of tonight. I'd like us to hand over to the main speaker. Thank you. What we're doing. Had anybody heard of Rachel Carson, by the way? Did anybody know the Silent Spring story? Yeah. Maybe we should have a competition during this brief recess. If anybody can think of what would be a good title. Steve's actually come up with a working title for his next grand oeuvre, but it's not as catchy as Silent Spring. So
that's true. Finance leave my great name.
Exactly.
Yeah. Okay. Anyway, let's just get this rolling properly. Right scale. Get rid of that. Lots of cables here. Reminds me of my living room.
Single living room.